Meantime, we mentioned jobless claims before. Jobless claims hitting their highest level since early September. They came in far above expectations, and this obviously comes as the virus worsens nationwide. Let's get to CNBC senior economics reporter Steve Leisman. And Steve, you earlier today called this a claims calamity. Shouldn't we have expected this fully given the rise in the number of cases?
Not necessarily, Melissa. It's not always been clear that the claims data has followed the coronavirus surge, but indeed we can show that it has. And maybe you should have expected it. And maybe you know what's funny, Melissa? I'm not even sure I can talk to you guys anymore. You're my favorite people, Melissa, Karen, Dan and Tim and Guy. But we're talking different languages here, you know. I'm telling you, there's nearly 900,000 people filed for jobless claims in the last week. You guys buy stocks. 250,000 new cases average 7-day from Johns Hopkins. You guys buy stocks. 20 million Americans receiving some form of unemployment claims. And worse than that is the outlook is terrible for this in the next several months. We're talking about, Ian Shepardson forecasts that the number of claims could go back to 1 million pretty soon. I've got several economists forecasting job losses for the month of December when the payroll number comes out. That's not for sure, but that's in the month. And none of this matters, and that's okay. I'm not telling you guys how to trade stocks. I don't even get involved in that. I'm just telling you where the economic data is going this month, next month, and for the next several months until we can turn this thing around. And then there's another debate to be had, which is how much of what's happening right now is undercutting the recovery when it happens. Longer people are jobless, the more businesses close down, the less there is to recover. So you guys do your thing. I'm going to do my thing, which is to tell you 900,000 people. It is an absolute calamity, and then they're going to lose their benefits. So go ahead and trade stocks. I'm just telling you what the data say.
We all love you as much as you love us, but I'm going to let these guys in. They're chomping at the bit. Dan, go ahead.
But listen, Steve, when we watch you all day long and you do a great job reporting on this stuff, you obviously don't watch our A block every night because there's at least 2 or 3 of us kind of echoing exact sentiment that you're saying.
I know.
We understand there is a massive disconnect.
I know, Dan.
I know, but
I know.
I just want to be clear on that.
And some
of us kind of take a lot of crap for it every night, too.
Or to Tim. I love you guys. I love you guys. I'm sorry. You're just like that. You're the proxy for me right now.
I just want to be, hey, Steve, listen, I just want to be really clear. There's other shows that do that, not this show, okay? We take this stuff very seriously. And so when we have economic data like we had this morning, it's not just buy stocks, okay? I just want to get that
I think he was using us as a group, the trader mentality sort of thing, and why the stock market's at record highs. But here, Steve, is where we meet in the middle, because we do, as friends, like to find common ground. And that is, we are starting to see this deteriorating data show up in what companies are beginning to say. Just yesterday, we talked about Starbucks saying that in the United States, December is starting to soften. Southwest Airlines seeing cancellations up, bookings softening. So I guess the question is, Steve, as we enter this sort of downtick once again in the economic data, and I'm lumping together the retail sales number as well as we go into the final stretch of the year. Are we talking about an economy that will never see the depths that we saw in the beginning of the pandemic because we've got optimism, a vaccine is out there being injected into the arms of healthcare workers as we speak? Or are we talking about an economy that has endured lasting damage because this is the second downturn, not just the first?
I think there's going to be both. I think there's going to be some lasting damage, and it's the scarring that's the issue here that really is the one that concerns me. And look, part of this is a frustration on my part. I mean, the economic data in the 17 years I've been doing this for CNBC has been absolutely critical to the trade. I have never, ever seen the market relegate the present data so quickly to the past as it does right now. And I think, with what you're saying, Melissa, it is interesting that now it's starting to show what companies say, but I think it's telling us a bit about the inequality in the economy, which is critical, which is that the people who are being hurt most are not having an effect, or a huge effect anyway, on existing corporate earnings or the outlook for corporate earnings. I think that's a big part of how this economy and how stocks and Wall Street and Main Street are different here. I think that's critical. And I just want to reiterate, guys, you're my favorites. I just come on with this data, and the stock market goes up to full-time high. And I'm not saying that's wrong.
Steve.
I'm not saying that's wrong. I'm just saying this is what the data are.
By the way, we won't tell any other shows that we're the favorite, not them. Karen, you want to get in?
Yeah.
I do. So, Steve, let me ask you. I hear what you're saying, and I know that, if you're unemployed, you don't care what the PE multiple on the market is. I totally get that. But in all your time looking at data, have you ever been in a period where the data from 8 months ago and 8 months forward, and where we are right now in the middle, will have moved so dramatically as it has now? That seems highly unlikely.
I think that's a fair and great question, but what I would counter that with is we have completely changed the way we look at the economy during this crisis. And by the way, we're not going back, which is we do follow the high-frequency data. I didn't have a report for you today on the high-frequency data, but the credit card data, the JP Morgan credit card data, I just looked at it. It's down about 5% this holiday season compared to last year. So that's a piece of it. We are able to gauge the economy pretty well in real time right now, and it's not great. But look, the idea, I think the market was up during a lot of the Great Depression. The idea that you guys are trading on the future, I get that, but it doesn't change what's happening right now, which is the real calamity that's going on for many Americans right now in the economy.
Steve, it's always great to have you. Thank you.
My pleasure. I hope you have me back.
Of course. Steve Leisman. Guy Adami, I don't know if we're trading on the, we are trading on the future as much as we are trading on the notion that we know that Fed liquidity will be there and be there for an indefinite period of time.
Yeah, listen, first of all, Steve Leisman takes some of the most arcane material and makes it accessible to a broad swath of the population. That's not easy to do. Steve is brilliant, and I admire all the work he does. I mean that, and I understand what he was saying, and I totally get that. But let me say this as well, because he alluded to it. For more than 10% of the population, there's a depression going on, flat out. I'll use the word without question. This is late 1920s, early 1930s stuff for a lot of people out there. And they look at the stock market, and they're saying exactly what Steve said. How is this possible, given what we're going through? But the answer is the same conversation we had last night. It's the fact that Jerome Powell comes out and says valuations don't matter in this type of basically zero interest rate environment. And the market says, you know what, if that's what you think, party on. So to a large extent, the Fed that he covers so well, in my opinion, that's what makes markets, is the root of this problem in the first place.
Shepard Smith here. Thanks for watching CNBC on YouTube.